Welcome to the Overberg Asset Management Market Review. If you find this video helpful, please press the like button and don't forget to subscribe to see our upcoming market reviews.
Good day, I'm Carel, COO and Director at Overberg Asset Management, based in the Hermanus office. There's been two ex-prime ministers that came under fire last week, and in the first instance, in the literal sense, ex-prime minister of Japan, Shinzo Abe, was assassinated while addressing a crowd at an election rally. So that's quite sad news. He was the longest serving Japanese prime minister and will be remembered for his Abenomics, which saw quite accommodative monetary policy. And then the other prime minister that came under fire, or in the figurative sense, was Boris Johnson, after a raft of his MPs resigned, coming under immense pressure, and he eventually stepped down. So we're going to have a new UK Prime Minister, and Rishi Sunak, the former Chancellor of the Exchequer, he's currently leading the race, or the bookie's favourite to become the leader of the Conservative Party, and then also, by extension, the new Prime Minister of the UK. And then over to America, Elon Musk terminated the Twitter deal. That deal was worth $44 billion, and the termination penalty on that deal will be $1 billion. I suppose for a multi-billionaire, that's probably not too bad, but there's likely to be quite a long legal battle over that deal. So Twitter will be suing him to complete the deal, and Elon Musk has blamed Twitter for not disclosing the true number of fake accounts and bots on their platform. So that's likely to be in the news for some time to come. And then on the lighter side, if you're stockpiling Dijon mustard in your cupboards, now would be a good time to sell those to the French. There's a world is running short of Dijon mustard, and it's affecting Europe and also the Mediterranean. And that's due to bad weather in Burgundy and Canada, where most of the mustard seeds come from. Also, the Ukraine, that's a producer of these seeds, they're obviously used as a backup, but they're not producing at the moment, as well as shipping and transport log jams. So the French are really in a panic about it. So if you have some Dijon mustard, I know a market for it. All right, so let's go over to the global markets, and these are some of the views from MRB Partners. They think that the current pessimism is overdone. So global markets currently worried by the recession fears in the US and also the developed markets, and it's affecting all asset markets. Some evidence of that is currently being played out in the commodities market. So oil prices have come down despite quite a tight supply. Prices are almost down to levels pre the Ukraine war. Copper is currently at an 18-month low, and wheat prices has also come down to pre-Ukraine war level. So what does all of this mean? It's quite positive for inflation worries. A lot of these commodity prices feed into prices for goods. So seeing prices drop in commodities is quite a positive for the outlook, and by extension, the rate hikes that we might see. So MRB don't think that central bank policies and the level of bond yields at current levels are restrictive for economic growth, and they don't think that this will cause a recession on their own. But there remains some uncertainty caused by the surge in inflation, and investors have a tendency to de-risk in these conditions. And I think that's what's currently being played out. MRB believes that the bond market has entered a second pause phase. So when we look at treasury yields, they were rising during 2021. Then there was a brief pause. Then we saw a rise again at the start of this year, and there's currently a bit of a pause again. And they say the pause, they're less bearish on risk assets than the consensus view because of this. So extreme pessimism will diminish for a period of time, and they see a calm in the bond markets now that recession fears are high and inflation gauges set to ease. So I don't think that the next rise in bond yields come, after this pause, not for at least another 3 to 6 months. They also think that investors have front-run a recession and have sold off some futures on commodities. So that's definitely driven down commodity prices, but it's also meant that key input prices and sources of inflation has come down. So what this means is that central banks will become less hawkish when the inflation starts easing, and investors will sniff out a change before the central banks actually provide confirmation of that. So critical for the pause in bond yields is that measured and expected inflation must ease, which MRB anticipate will happen. Conditions for equities to sustain a durable rebound. So the first one there is bond yields need to have decisively peaked. So we're not quite there yet. Central banks, especially the Fed, have to confirm rate hikes are not open-ended, so i.e. less hawkish. So we're not quite there yet either. And economic indicators need to confirm slowdown won't be lasting. And that is to avoid broad corporate earnings slowdown expectations. So when we look at some of the surveys, consumer and business sentiment surveys of the past week, they definitely show recessionary type readings, but the final demand growth is still decent, despite slowing down. A lot of the surveys from this week surprise on the upside in most countries, but especially there's a rebound in China and Japan. There's a wide divergence between current conditions and fears for the future, which exist especially in the EU, and that's understandable with the war in Ukraine, spike in natural gas prices and electricity, and also uncertainty about energy supplies this winter. But a lot of this is already priced in equity markets and also in the credit markets in the EU. So there's a good chance of Europe entering a recession, but it won't be a normal recession. And it's mostly because of energy prices and uncertainty there. And it'll be easier to restart once energy problems subside. So I think maybe a technical recession, and then the EU will grow again. The ECB will likely ease off policy tightening in the face of an economic shutdown, despite inflation above target. So I think they'll likely run the economy a little bit, or inflation above target, for extended period of time to avert, a total economic collapse. Easing commodity prices will definitely calm inflation fears. So commodity prices coming down, definitely helping the situation. And finally, underlying global economic conditions are more resilient than widely perceived. Over to the US and looking at equities versus bonds, and especially at corporate earnings. So forecast for corporate earnings in the US has finally come down, and that's due to worries about the economic outlook. But consensus still project healthy growth rates in S&P 500 earnings for this year at 11% and next year at 9%. So although they've come down, those earnings still look quite healthy. So this from Capital Economics. They also don't forecast a recession in the US economy, but they do expect US corporate earnings to fall. So their view is that the S&P 500 will underperform treasuries as earnings start to drop. So their view, S&P 500 at the end of this year be at 3,400 points, and it's currently at 3,800. And there's quite a bit of a drop there. And they expect the 10-year treasuries to be back up to 4%. So if you look at the drop in equity markets versus the potential fall in bond prices, treasuries on that outlook will outperform. Also in 2023, the outlook for treasuries improve as rate hikes end, but for equities, earnings remain quite bleak, and they will remain under pressure. Then over to the second largest economy. Let's talk about China and the recent bounce we had in stock markets there. So this from MRB Partners. The economic reopening after the COVID zero lockdowns has prompted foreign investors to pile back into the Chinese stock market. Local investors are also bargain hunting, so they've also helped drive the stock market higher. That's caused substantial short-term outperformance relative to other emerging markets and developed market stock markets. So far, the rally has been driven exclusively by a re-rating as opposed to forward earnings momentum in China, which continues to be quite negative. Earnings need to follow through in the immediate months for the rally to be sustained. Another detraction to sustained equity market acceleration in China is also the housing sector, which will remain in the doldrums. The view from Capital Economics is similar. They think that the resurgence in China's stock market may already be over. They think the Chinese stock market will struggle alongside other major equity indices over the next 1 to 2 years. And they also predict that China's economy will underwhelm because of many of the policies that hurt its tech sector remains in place.
Hi, Carel. Thanks for a very interesting and comprehensive macro and global overview. From the local side, the FNB and the BER, the Bureau of Economic Research at Stellenbosch, they brought out the Consumer Confidence Index and for this second quarter, and that is a quarterly reading that plunged to minus 25, which is a second quarter, and that was the lowest reading since the first quarter of 1986. So it's the lowest reading in 34 years. It's really serious. It's signs of a recession that can be coming to us. The reasons for this drop is worsening economic conditions and elevated inflation, and the outlook for interest rates. Interest rates are rising, and that's why the people are so despondent. They've got very little confidence. In the USA, their confidence levels are the lowest in 10 years, so all over it's not going very well. Good news comes from City Lodge Hotels. We own those shares. They announced that the deal of the 2 hotels that they sold in East Africa, that deals are now done and the money is in the bank. They confirmed that they have received the proceeds of the sale and they have already used it to repay some of their debts. Naspers and Prosus, they're in the process of buying back shares. What is interesting here is that they're buying back a lot. The numbers at Prosus and Naspers are just staggering. Last week alone, Prosus bought back $429 million of shares, and Naspers bought back 1.7 billion value of shares.
All right, thanks, Gielie.